Hi friends, good morning. So we'll be doing chapter number 15 today, that is analysis of financial statements. Now last class we had completed our chapter number 11, financial instrument. So completely the financial instrument is over. We're left with actually two topics. One is your analysis of financial statement, and number two we are left with is your Ind AS 101, first time adoption. After that there are some theoretical topics, that's okay. So today's target is to finish off chapter number 15, analysis of financial statement, 2 hours. Chalo, let's begin. We're starting with chapter number 15. Okay, now in this chapter, we'll be having bit of theory given first of all. And after that, this chapter is nothing but a mixture of your schedule 3 with all your Ind AS together. I repeat, this chapter is a mixture of what? Your schedule 3 plus all the Ind AS together. The name itself says you're analyzing what? Financial statement. So we are analyzing the financial statement. Is the presentation disclosure as per schedule 3? Is the accounting treatment done as per your Ind AS? So are there any mistakes based on schedule 3, based on Ind AS that we need to rectify, and we have to redraft the financial statements? So I told you this is a mixture of schedule 3 and all your Ind AS together. Okay, so check out, first of all, they have given that if at all the financials are prepared properly, it helps the users in making proper decisions. But if financials are not made properly, there will be trouble. The decisions taken will be wrong one. That should not happen. The financial statements are a key source of communication to the users. So financial statement are a source of critical communication between entity, users, stakeholders. That's okay. Now directly going to characteristic of a good financial statement. What are the characteristics of a good financial statement? The good financial statement should show a true and fair view. It should show a true and fair view of the state of affairs of the enterprise. Okay, understandable. It should show all the relevant information. So all relevant information needs to be shown properly. Relevance. Okay, now just tell me one thing. Do we give previous year figures? Yes. Okay, do we give last 10 years ke figures? No. Reason is, okay, you give last year, people are able to compare. You give last 10 years, that might be irrelevant. So there's no point giving that much historical data. Third, your financial statement needs to be understandable. Okay, the financial statement may understandable it should be. Okay. Then it should be consistently prepared. The accounting policies which you're following should be consistently followed. Change in accounting policy, the proper disclosure, proper treatment has to be given as per the relevant Ind AS. Fine. You need to comply with regulatory frameworks. So whatever rules, regulation, laws are there, that needs to be complied. And last one, universality. Universality means it has to be comparable. It has to be comparable with your past financial statement, plus it has to be comparable with your industries. Yeah, the similar industry, other company, my financials, their financials should be comparable. The financial statement should be comparable within the industry and outside. Within the industry and outside means if in your industry, like say for example you're manufacturing steel, if steel industry people follows FIFO for stock valuation, better you also follow FIFO for stock valuation. So I should be following the policies with that industry people are following. Clear? Okay, so what are the good characteristics of a financial statement? One, it should show a true and fair view. Two, all relevant data has to be shown. Third, it has to be understandable. The language used should not be too complicated. Fourth, consistently it should be prepared. It need to comply with the regulatory frameworks. And last one is universality, is comparable within the industry as well as outside. Now, again one theoretical thing is given, best practices. Best practices to be followed by all the company. See, these are some of the best practices given to you that you should follow. All the companies should follow this best practices. This is to ensure the financials are prepared in a good way. This to ensure the financial statements are prepared in good way. So see, if followed by the preparers of financial statement, It will lead to better presentation disclosure, and it will give a good data to the users. They will be able to take better decisions. The following are some of the practices. If followed by the preparer of financial statement, it will lead to what? Better presentation and disclosure. Okay, so which are the best practices to be followed? One, your financial statement will comply. It has to comply with basically laws, regulation. It should comply with Ind AS. The compliance. It needs to comply with the standard, comply with the regulations. It needs to comply with standard, it needs to comply with regulation. And whenever I say comply, it has to comply with the regulations or standards in a proper way. Okay, they've given an example of accounting standard 13, not Ind AS, AS 13. AS 13 is on? Sir, AS 13 is on accounting for investment. Okay, under your AS 13, your long-term investments are carried at cost unless there is a diminution. Unless there is a diminution other than temporary. If other than temporary diminution is there, okay, then in that case the value is reduced. Now most of us when we were in CA intermediate, rather than using the word other than temporary, we used to use the word permanent diminution. So they are carried at cost unless there is a permanent diminution. There is a difference between other than temporary and permanent. Okay, imagine there's a diminution which will be expected, or there's a diminution which is expected to be reversed in 4 or 5 years. There's a diminution which is expected to be reversed in 4 or 5 years. Is it a permanent diminution? No. Keep on replying. Is it a permanent diminution? No, because it's expected to be reversed in 4 or 5 years. But is it other than temporary? Yes. So it's not like 1-2 year wala. 1-2 year is temporary. Short term down ho gaya, that's temporary. But 4 or 5 years mein it will again come back. It's other than temporary. So they say that you need to follow the standard in a way given. Don't try to misinterpret it. ठीक है. So it is not appropriate to term other than temporary as permanent diminution. You need to comply with standards, regulation, best practices to be followed. Okay, complete. Number 2. The information disclosed in financial statement should be complete. It should not lead to some cross-questioning in the minds of user. ठीक है तो. The information given should be complete. Like suppose if you write, the balances of debtors and creditors are subject to confirmation. Okay, if you've written in notes, the balances of debtors and creditors are subject to confirmation, the people will feel the balances are not the final one. That should not happen. ठीक है. Third, all your accounting policies which are there, you draft it in a simple way. So accounting policies should be drafted in a simple English. Try to use smaller sentences rather than a big sentence. A sentence going in 4 lines. No. Divide the sentence in 3-4 parts. The sentence is going in 4 lines. No, divide the sentence in basically 4-5 sentences. It becomes easy to interpret it. For example, they have given the definition of derivative. Okay, we already did this derivative in chapter number 11, financial instrument. The derivative is a type of financial instrument which a company uses to manage risk. Okay, now see full stop. It is something that derives its value from underlying asset. Full stop. It's generally in form of contract between 2 parties. Full stop. The underlying variable like exchange rate or something will cause the value of that derivative to change over time. Full stop. It will be settled in future. So this is how they have divided that whole part into smaller sentences, easy for people to understand. Did you understood? Okay, the one best practices mein your financial statement has to comply with Ind AS rules regulation. 2, it has to be complete. All disclosure should be complete. It should not lead to questioning in the minds of people. Third, the notes should be drafted in simple and plain English. Note should be drafted in which type of English? Simple and plain English. Fourth, you need to disclose all the things transparently. Yeah, all things has to be disclosed what? Transparently. Disclose assumptions, bases, whatever are used transparently. Fifth, all material items all material items has to be properly accounted, properly disclosed. You remember, if something is immaterial and I don't follow Ind AS over there, if something is immaterial, I don't follow Ind AS over there, is it okay? Is it okay? Something immaterial, I'm not following Ind AS over there, is it okay? Definitely yes. Ind AS are intended to apply only for material items. Ind AS are intended to apply only for what? Material items. And materiality is a kind of filter. What to disclose, what not to disclose. If it's material, disclosure required. Not material, disclosure not required. Okay, the check over here. Information should only be disclosed if it is material. Material is something which could influence the decisions of users of financial statement. ठीक है, तो materiality assessment is a filter in determining what to disclose, what to omit. Is it clear? Okay, then all your notes should be integrated properly. Okay, if you just recall, whenever you prepare financial statement, in your financial statement, say when you write PP, the details about PP is given in notes. And that's why the format of balance sheet is particulars, note, current year, previous year. Particulars, note, current year, previous year. Each item of balance sheet P&L is to be cross-referenced with a related note. Each item of balance sheet P&L is to be cross-referenced with a related note. So integration of notes. Notes are the biggest portion of financial statement, and that are the most important thing. The real picture about company people will get from notes. Okay, so group notes into categories, place the important notes more prominently, integrate your main note of line item with the accounting policy, etc. And ensure that all accounting policies are disclosed at one place. Your note number 1. When you come to notes to accounts, your note number 1 is significant accounting policy. Okay. Then they are telling you disclose all your accounting policies, but only the significant one. So you can't keep on having policy for every small things and you disclose. Otherwise, that will run into basically several pages and it will be more confusing for the people. So you should disclose all your significant accounting policy. Disclose only significant, remove the insignificant thing. I tell you one thing. Imagine there's a company which doesn't have foreign exchange transaction. Okay, there's a company which doesn't have foreign currency transaction at all. And they have disclosed their policy about foreign currency transaction. They have disclosed their policy about how do they hedge the forward contract. Is it necessary? There's a company which does not have a single foreign currency transaction. I don't have any single foreign currency transaction, but in my notes to accounts, I've written my policy about how do we account for foreign currency transaction? How do we account for the hedge entered for forward contracts for foreign currency transaction? All that things are written in notes. But dear, I don't have such a transaction. So there's no point writing all that things. It's not required. Correct? Correct? Okay. So what is significant, what is not significant, you need to decide. Okay, next one, disclosure of key estimates and judgment. Okay, whatever estimates you have made, whatever judgments you have made, that you need to disclose it. Okay, the checkout. Include detail on how estimate was derived, key assumptions which were involved, the process of reviewing, and how did you analyze the sensitiveness. Now, what is the sensitiveness? You know, there's a word called sensitivity analysis. Now, what is the sensitivity analysis? Okay, imagine, say for example, we are assuming a growth in business of 5%. Okay, we are assuming a growth in business 5%. So if 5% growth is there, these are the revenues and profits expected. If growth 5 ki jagah 6%, what will be the effect? If growth 5 की जगह 4%, what will be the effect? That's called sensitivity analysis. That's called sensitivity analysis. Okay, the disclose, key estimates, judgment, and last, integrated approach. Now, in your old syllabus, not the current one, in your old syllabus, there was a chapter called integrated reporting. Achha, under integrated reporting, what happens is we try to report the holistic picture. I repeat, we try to report the holistic picture, where we are, where we want to reach, and how we are going to reach there. I repeat again, where we are, where we want to reach, and how we are going to reach there. The holistic picture is being basically kind of explained, not just the financials. Not just the financials. We talk about financials, we talk about the human capital, the employees, etc. We talk about machine, etc. Our basically physical capital, that is called. Then we talk about intellectual capital, our patents, trademarks, copyright, what do we have? So many things we talk about. We talk about the overall picture of the company. It's a holistic reporting. It's a holistic approach where we communicate overall aspect of company. Where we are, where we want to reach, and how we will reach there. Where we are, where we want to reach, and how we are going to reach there. Okay, now question. If at all integrated reporting is done, my question is integrated reporting a part of financial statement? Is integrated reporting a part of financial statements? No, it's not a part of financial statement. It's some extra things you are trying to disclose. It's not a part of financial statement. And see, Ind AS applies to financial statement. Your Ind AS are applicable to financial statement. The question, if I have some integrated reporting done, I give some other reports. So whether to them Ind AS will be applicable? So under integrated reporting, I'm giving some other reports. So whether to them integrated reporting will be, whether to them your Ind AS will be applicable, answer is no. Perfect. So check out. Financial statement are one part of communication with stakeholder. Annual report. If I go to annual report, it includes financial statement. It includes management commentary, management discussion analysis report, MDA, management discussion analysis report is there. Then there's a CSR reporting, then there's a business responsibility reporting. So many other things are there basically in annual report. There's a growing trend towards integrated reporting, holistic approach, where we are, where we want to reach, how we are going to reach there. Okay. Now, even though these reports, etc., are presented, are outside the scope of AS or Ind AS. See, Ind AS 1 has clearly said, that if at all you give anything extra, to them Ind AS don't apply. Okay. So check over here. The reports presented outside financial statement are outside the scope of Ind AS. Reports presented outside the financial statement, they are outside the scope of Ind AS as well. Fine, but there's a kind of holistic approach wala thing nowadays people are trying to follow, not mandatory. Not mandatory. ठीक है, तो now just check out which were the best practices to be followed by company. Number one, your financial statement is to comply with Ind AS as well as laws and regulation. Number two, the financial statement should be complete. The disclosures which you're doing should be complete. It should not lead to ambiguity in minds of people. Example I gave you, balance of debtors, debtors, creditors subject to confirmation. Third, the language which you're using, especially in notes, should be simple, and the policy should be drafted in a plain English. It should be easy for people to understand. Fourth, all your assumptions, etc., what you are doing, you need to disclose it transparently. Fifth, all material items has to be properly disclosed. Material is a filter for you. Sixth, the notes has to be integrated. Every item of balance sheet P&L cross-reference with a related note, and note should be given in a proper sequence. Okay, accounting policies which you are following, the significant ones has to be disclosed, and we know note number 1 is disclosure of significant accounting policies. Eighth, your key estimates and judgment needs to be disclosed, and try to have a holistic approach. Now going to the question. I told you this chapter is nothing but a mixture of schedule 3 plus all your Ind AS together. Okay, so now we'll have a revision of kind of schedule 3, we'll have a revision of all Ind AS together. Let's begin. Chalo, question number 1. Question number 1. C Limited is a group engaged in manufacture and sale of industrial and FMCG product. C Limited is group engaged in manufacture and sale of FMCG product. Okay. One of the division deals in leasing of property. Acha, so one of your division is dealing in leasing of property, and the accountant had showed that leasing income as other income. My question is, your leasing income other income? No, my routine operation is this. One of my division is into leasing. If one of my division is into leasing, for me the leasing income will be my revenue from operation, not other income. Did you got it? So whether the classification is correct, answer is no. So presentation of rent arising from leasing and other income is not correct. It should be shown under revenue from operation. Tulsiram, Vishnupriya, Vidhi, Pooja, is it clear? The presentation as other income is not correct. It should come under your revenue from operation. Thank you. Please keep on replying. Okay, now going to question number 2. Now see, whenever I come out with a bonus, issue, if you recall, as per schedule 3, for a period of 5 years, I need to write down. Out of about this many shares are issued by way of bonus. Yes, no? So for a period of 5 years, schedule 3 requires that you need to write down out of about this many shares are issued by way of bonus. Question, whether the source of bonus issue is to be given. Means out of about this many shares are issued by way of bonus by using securities premium, or by using general reserve, or by using retained earning. That's the source. So whether source of bonus issue required. Okay, in the financial statement, Alpha has mentioned in the notes. What they mentioned in notes? 24,000 equity shares of 10 each are issued fully paid up as bonus. However, the source from which bonus is given is not disclosed. Source is not disclosed. Now, source is not required only. As per schedule 3, you are just required to tell the number of shares issued by way of bonus in your note of share capital. The source of bonus issue not required. Is there a violation of schedule 3? No. Is there a violation of schedule 3? Answer is no. The non-disclosure of source non-disclosure of source from which the bonus issue has been made is not violating Schedule 3. Schedule 3 does not require the disclosure of source. See, Schedule 3 does not require the source from which the bonus issue is given. You're just required to tell how many number of shares are issued by way of bonus. Okay, third question, very good. Third question is really very good, and I tell you, in CA final, you don't have division 1 of Schedule 3, you have only division 2. Division 2 is for those companies following Ind AS. Okay, so the presentation disclosure they have given, we have to rectify it, and we are required to rectify and give as per Ind AS. Okay. The balance sheet is given. The balance sheet is given. Now they've started with equity and liability. They started with equity and liability. If you recall, under your Schedule 3 Division 2, we start with assets. So this is the first problem. I'll just write number 1. This is the first problem. Okay, then they've given share capital. Now see, actually the heading is equity. Pehle equity and liability, under that equity. Under equity, equity share capital. Under equity, there's equity share capital, and then there is other equity. So this is number 2. It should be under the heading of equity, equity share capital, and it should be other equity. It should be other equity. Acha, employee stock option outstanding is nothing but SBPR. Share-based payment reserve. It's SBPR. SBPR should be a part of other equity. It should be a part of other equity. It should be a part of other equity. This is also a problem. Okay, share application money refundable should come under liability. This is also a problem. Okay, the first of all, it should start with asset. Okay, that's one. Acha, now when I come to equity and liability, there has to be a heading called equity. Under equity, there should be equity share capital. Instead of reserve surplus, the word is other equity. Word is other equity. Acha, employee stock option outstanding should be part of other equity. Share application money refundable should come under your liability. Under your liability, current liability. Under current liability, other financial liability. Under current liability, other financial liability. Okay. Your non-current liability. Under your non-current liability, you have a deferred tax liability. And if I just go down, see, यहाँ पे they have given a deferred tax liability. Here they have given a deferred tax asset. Now, DTA, DTL comes under non-current asset or non-current liability. DTL correctly given under non-current. But DTA given under current, this is wrong. DTA cannot come under current. DTA should come under non-current asset. And question, can I offset DTA, DTL? And can I present net? Can I offset DTA, DTL? They've written arising from Indian income tax. Here also arising from Indian income tax. So should I offset DTA, DTL and present them net in balance sheet? Yes. Yes, so net DTA or net DTL should appear in balance sheet and it should come under your non-current liability or non-current asset. ठीक है, तो यहाँ पे there is a mistake, ये गलत है. Which was the last point we had written? 5. Okay, यहाँ पे I just write down 6. Net is to be shown DTA, DTL. So even if net DTA comes, it should not be under current asset, it should be under non-current asset. Okay, trade payable. If you recall, your trade payable is to be bifurcated as dues to MSME and others. The dues to micro and small enterprise other than micro and small enterprise. So there is also a problem here. Micro and small enterprise other than micro and small enterprise. Achha, we don't call it as fixed asset, we'll call it as PPE. We don't call it as fixed asset, we'll call it as PPE. Okay, CWIP is fine. Trade receivable is fine under current asset. Achha, but under current asset, I'll have a financial asset. Under current asset, I'll have financial asset. And under financial asset, there will be current asset. Achha, so current asset के अंदर financial asset, under that trade receivable. Reason, trade receivable have a contractual right to receive cash. As is a contractual right to receive cash, it will come under financial asset. तो तो under current asset, financial asset, under that trade receivable. अच्छा, P&L debit balance करने से it will come negative under other equity. It will come negative under other equity. These are all the errors which are there. Check out. Comment on the presentation based on schedule 3. We are doing it as per division 2. Division 1 not relevant, exam purpose, skip it. If you want, you read on your own. I go directly to division 2. Division 1 not relevant for exam purpose, CA final, I'm skipping it. The following errors are there as per division 2. Okay, the balance sheet should begin with asset, then comes equity and liability. Okay, under asset, under your non-current asset. Under the main heading, non-current asset, you should have a PPE and CWIP. They've written fixed asset tangible. No. The fixed asset tangible should be presented as CWIP. Acha, one more thing, if I just go back to question. Acha, now if you see over here, they've written, there will be this 10y, and this will be 11, and this will be 12. Okay, now they've written over here, including capital advance, CWIP including capital advance. Now see, if I give capital advance, whenever I'm giving capital advance, I'll be getting capital goods in future, machine. It's nothing but advance given for machine. It's nothing but what? Advance given for machine. I'll be getting machine in future. Do I have a contractual right to receive cash or other financial asset? No, I don't have a contractual right to receive cash or other financial asset. Capital advance comes under your other non-current asset. Capital advance will come under your other non-current asset, not under CWIP. Okay, so check out capital advances are not to be classified under CWIP. They will be disclosed under other non-current asset. This is done. Now, DTA should come under your non-current asset. They've given DTA under your current asset. That's wrong. And a net DTA, DTL should appear in balance sheet. It should be the net DTA appearing after adjusting DTL. Okay, debtors, I told you, under your current asset, financial asset, under that trade receivable. It should be under the subheading financial asset. Okay, share capital, reserve surplus should be under the main heading equity. The heading equity is missing. Achha, under that we'll have equity, share capital, other equity. Okay, the reserve surplus would form part of other equity. Uski jagah other equity should be there. Achha, P&L debit balance I'll be having under other equity. It will appear as negative under retained earnings. Achha, so P&L debit balance, you show retained earning negative. And because retained earning is negative, overall other equity can be negative. Did you understand? The P&L debit balance is negative retained earnings. Okay, employee stock option outstanding is SBPR balance. It should come under other equity. It should come under other equity. Okay, application money refundable. It should appear under other financial liability. So under your current liability, financial liability, under that other financial liability. Under current liability, financial liability, in that other. DTL is correctly given under your non-current liability. DTL correctly given under non-current liability, but you can't have both DTA, DTL. You should be having only the net, but DTA, DTL both cannot be presented. Only the net is to be disclosed. Okay, your trade payable will come under financial liability. So under your current liability, there will be financial liability. Under financial liability, trade payable. Trade payable comes under your financial liability. Okay. Trade payable comes under financial liability. And now it should be bifurcated as dues to micro and small other than micro and small. It should be disclosed as follows: dues to micro and small other than micro and small. Any doubts? Anybody? Any doubts? Anybody? Keep on replying. If the session is two-way, we enjoy more. Thank you. Okay, going to question number 4. Going to question number 4. As an auditor, give your comments for the following disclosure. ठीक है. In balance sheet, the subheading inventory. The inventory contains goods in transit. Inventory contained an item goods in transit in which consolidated amount aggregating the raw material in transit and is a consolidated amount. So you have written a word goods in transit. Goods in transit includes your raw material in transit as well as loose tools which are in transit. Acha. Now my question. Raw material in transit, finished goods in transit. I have just combined or shown it as goods in transit. Is it okay? If you recall your schedule 3, if goods are in transit, it should be shown under the relevant subhead separately. What is the word used? It should be shown under the relevant subhead separately, means raw material in transit separate, loose tool in transit separate. I cannot show aggregate. So as per division 2, schedule 3, they are to be shown separately. Consolidated amount is not correct. So cost of raw material in transit should be disclosed under the subhead of raw material, and loose tool should be shown under the separate subhead of loose tools, kind of thing. Disclosure of a consolidated amount is not correct. They have to be shown under the relevant subhead separately. Okay, provision for doubtful debt, you are shown under liability side. Provision for doubtful debt, liability side. No, deduct from the debtors. Deduct from the debtors. The term doubtful debt is an adjustment to the carrying amount of asset. So it should be shown net in trade receivable. It should be shown net in trade receivable. So this is wrong. Okay, third one. Prior period income shown as other income. Okay, prior period ka some income, we have shown it as other income. Wrong. Now sir, why wrong? Prior period income shown as other income. Now see, if at all there was something related to past which we forgot. If at all there was something related to past which we forgot, it was an error. If it was a prior period error, now what do? How do I rectify the prior period error? If it relates to current year, I rectify the current year balance. If it relates to previous year, the previous year's figures are restated. And if it relates to period before previous year, the opening balance of previous years are restated. The opening balance of previous years are restated. Achha, if it was not an error, it will come in current year only under the relevant point, whatever it relates. So showing it as other income is not correct. Okay, the checkout over here, prior period income should not be shown. You need to adjust the opening balance. Acha, if it's for a period before previous year, of the each item of equity affected as well as the comparative amount which has been disclosed. Okay? And last one, you have a scrap relating to manufacture. A scrap relating to manufacture, deduct from the cost of manufacturing. Scrap relating to manufacture, I should not show it under other income. It should be deducted from where? So the cost of manufacturing. So Scrap relating to manufacture, checkout. It should be deducted from the cost of main product. Disclosure as other income is not correct. Any doubts? Anybody in this question? Any doubts? Anybody with this question? Okay, moving on to the next one, question number 5. Moving on to the next one, question number 5. Okay, Deepak started a new company, Soft Bharti Private Limited with Iktara Limited, wherein investment of 55% is done by Iktara and rest 45% is held by Deepak. ठीक है. Okay, so see, there is Iktara Limited and there is Mr. Deepak. They come together, they formed Soft Bharti Limited. Soft Bharti Private Limited. Okay, Iktara holds 55%, Deepak holds 45%. Deepak holds 45%. So can I say in Soft Bharti, Iktara holds 55%? Achha, if Iktara is holding 55% and if at all the voting decisions are based on voting right, if decisions are based on voting right, can I say Soft Bharti is a subsidiary of Iktara? ठीक है. They've clearly given the voting powers are proportionate to capital contribution. So therefore, the new company, it becomes a subsidiary. So I can understand the Soft Bharti is a subsidiary of Iktara. The financials of Iktara are as per Ind AS. Financials of Iktara are as per Ind AS. Now, if your parent follows Ind AS, you also have to follow Ind AS. The Soft Bharti also needs to follow Ind AS. Soft Bharti also needs to follow Ind AS. ठीक है. The new company was a subsidiary of Iktara. A consultant was hired, 30,000 incorporation expense was there and 30,000 incorporation expense was charged to P&L once the company is formed, correct? Once company is formed, incorporation expense go directly to your P&L, they are not capitalized. And they've given you, the new company is formed in 1st April. Okay, 1st April, and I just write down over here, therefore, financial statement of Soft Bharti Private Limited should also be as per Ind AS. Fine. Now there's a P&L given. There's a P&L given, Soft Bharti ke draft financials March 2. Okay, in your P&L, revenue from operation, other income, total. ठीक है. Under expense, there were purchase of stock in trade, increase, decrease in stock in trade. Now, under your division, मतलब 2 of schedule 3, schedule 3 के अंदर we have a vertical format. So how do I have a COGS? Opening stock plus purchase minus closing stock. How do I have COGS? Purchase of stock in trade, increase, decrease in stock. Increase in stock, profit should go up, we deduct from expense. Increase in stock, profit should go up, so we deduct from expense. Decrease in stock, profit should go down, we add it in expense. So this is an increase in stock. This is increase in stock. Employee benefit, depreciation, other expense. Okay, then we have a profit before tax. Profit before tax. Okay, current tax, deferred tax. Current tax, deferred tax, total tax, and then profit for the year. Balance sheet. They have given it AS format. They have given a balance sheet under AS format, starts with equity and liability. Under Ind AS, it starts with asset. Under Ind AS, it should start with asset. So I write over here, under Ind AS, it should start with assets. This is given as first of all equity and liability. No, it should be as per Ind AS. Okay, share capital की जगह word will be equity share capital. Instead of reserve surplus, the word will be other equity. Under your non-current liability, they're given long-term provision, deferred tax liability, and under current liability, they're given short trade payable. Trade payable comes under financial liability. Other current liability, short-term provision. Okay, under your non-current asset, they're given a PP, long-term loans and advances, other non-current asset. Okay, current asset के अंदर they're given current investment, inventory, trade receivable, cash. Now see, there has to be a heading financial asset. The heading financial asset, financial liability is missing. Now, additional information. They have given what? Okay, DTL of 6,000 is created due to temporary difference. DTL is created 6,000 due to temporary difference. Check out balance sheet. Do you have a DTL? Yera 6,000. Okay, this temporary difference is due to what? Depreciation. They've given difference in depreciation is there. Okay, now just check out. Because of depreciation, can I say now the values of asset as per books and value of asset as per income tax will be different? There's only one PP. And balance as at 31st March to balance as at 31st March to books में asset 1 lakh, tax में we got more depreciation. The tax में the balance is less. Now tell me one thing. Asset in books is more. We are going to get more economic benefit in future. We have to pay more tax in future. We create DTL. Yes, no? Asset in books is more. We get more economic benefit. We are going to pay more tax in future. DTL. The 20,000 ka 30%. This is 6,000 DTL. Did you got it? 20,000 ka 30%. 6,000 DTL. As per books, 1 lakh. As per income tax, 80,000. So DTL is 20,000 ka 30%. Which is already there. ठीक है. Now pre-incorporation expense. Remember 30,000 rupee preliminary expense? Okay, that goes to P&L immediately. But tax में they are going to allow over a period of 5 years. Okay, the books में 30. Tax में they allowed only 6. 24 they will be allowing later. Okay, some expense they will allow later. Can I say future I have to pay less tax? So 24,000 into 30%. 24,000 into 30%. So can I say DTA to be created? It is 24,000 into 30%. This will be coming as 7200. तो DTA आपका आना चाहिए 7200. Are you clear? Done. Okay, now tax is calculated 30% of PBT without doing any adjustment related to income tax. My question, the current tax, should it be 30% of PBT as per books, or should it be 30% of profit as per income tax? Your current tax, should it be 30% of profit as per books, or should it be 30% of profit as per income tax? Sir, it should be 30% of profit as per income tax. The correct current tax after doing adjustment of allowance, disallowance of income tax is coming as 125,700. Okay, so now you check out in the question PBT 355. Okay, 355 into 30%. 355 into 30%. Did you got 106,500? This is wrong. So it should not be 106,500. It should not be 106,500. Instead of that, it should be 127,500. They just told. So यहाँ पे there is an adjustment. यहाँ पे there is an adjustment. Deferred tax में there is an adjustment. Okay. ठीक है. I'll come back. 125,700 should be the thing. Okay, after the reporting period, after the year is over, the directors have recommended a 15,000 dividend. Directors recommend, this is proposed dividend. Okay, what is the entry for proposed dividend? Dividend is proposed, no entry. Entry for dividend done only when it's declared by shareholder. The proposed dividend, there won't be any journal entry. 15,000 is dividend and which has been deducted from reserves. Wrong, wrong, wrong. We'll add it back in reserve. And it had been grouped under other current liability. Okay, so we have to remove it. It will be added in reserve and it will be removed from liability. It will be added in reserve, removed from liability. Okay, so plus 15,000 in reserves. So I write over here other equity may plus 15,000 and other current liability may minus 15,000. Clear? Next, there are statutory government dues amounting to 15,000 which are grouped under other current liability. Now tell me, a statutory due, is it a contractual obligation to deliver cash? Is it a contractual obligation to deliver cash? No, 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 sir. It's statutory. It's a legal obligation, not a contractual one. It's a legal obligation, not a contractual one. Acha, as it's a legal obligation, it will come under other current liability only. Acha, now go and check other current liability. Here are other current liability. Other current liability is 45. Other current liability is 45. Out of that, 15,000 dividend payable wrongly, तो वो remove हो गया. 15,000 payable to government, correct. And remaining 15,000, I assume it's a contractual obligation to pay cash. That should come under other financial liability. Out of 45, 15 removed. 15 statutory dues will remain. And another 15, I assume it's a contractual obligation to pay cash. That should be shown as other financial liability. Clear? Okay. Okay, so what do I do over here? I'll just write it like this. Your other current liability. Other current liability. Okay, given is equal to 45. I bifurcate it. Okay, 15,000 dividend payable is removed. This was wrongly accounted. Okay, another 15,000 government dues. Okay, so it remains in other current liability and remaining 15,000, this is the balancing figure, assuming its contractual obligation, assuming it to be contractual obligation to pay cash, comma, it will come under other financial liability. It will come under other financial liability. If you're done, write down D. If you're done, write down D. Okay, moving ahead. moving ahead after this. Okay, there's capital advances given grouped under other non-current asset. Capital advances grouped under other non-current asset. Okay, I don't have a contractual right to receive cash. I'll be getting capital goods. It's correct. It comes under other non-current asset. It's correctly classified or correctly grouped. Let's check the other non-current asset. Do we have anything else in other non-current asset? Other non-current asset 50. Correct. There's no problem here. Okay, other current asset. Other current asset includes 51,000 interest receivable. Acha, other current asset. Let me go to other current asset. Do you see 51,000? Acha, interest receivable is a contractual right to receive cash. It's a contractual right to receive cash. Okay, it should come where? It should come under other financial asset. So under current asset, financial asset, under that others. It should come under other financial asset. Done? Okay, there's a current investment of 30,000 which we have done equity investment. Remember, equity investment is generally FBT PNL unless you choose an irrevocable option, FBT OCI. Okay, so over here, there's a current investment 30,000 in shares of a company and they have been carried at cost. No, wrong. They should be at fair value 50. Okay, the investment goes up. Okay, so plus 20 in investment. तो इन्वेस्टमेंट में प्लस 20. अच्छा, अदर इक्विटी में प्लस 20. इन्वेस्टमेंट में प्लस 20, अदर इक्विटी में प्लस 20. बट नाउ इन्वेस्टमेंट वेंट अप इन बुक. बुक में एसेट वेंट अप, टैक्स में नहीं. बुक में एसेट वेंट अप, टैक्स में नहीं. फॉर टैक्स पर्पस DTL to be created, it will be taxed later. Asset in books has gone up, the asset in books is more. So there's a DTL coming up. ठीक है. And PNL to DTL. DTL of rupees 6,000 to be created. Okay, the total DTL 6 related to depreciation, 6 related to this. 6 plus 6, 12 DTL, 7,200 DTA. 12 DTL, 7,200 DTA. Net DTL is 4,800. Net DTL is 4,800. ठीक है. Now actuarial gain of employee benefit 1,000 rupee has been omitted. Actuarial gain. Okay, now if you just recall, your employee benefit chapter. In your employee benefit chapter, we have actuary doing provision for gratuity, etc. There might be some actuarial assumptions involved. Okay, there might be some actuarial assumptions involved. Actuary changing certain assumptions, uske karan profit loss comes. Actuary changing assumption, uske karan profit loss comes. That goes in OCI. Do you recall? So this 1,000 rupee OCI में profit, opposite provision goes down. तो OCI में plus 1,000. OCI में plus 1,000 and opposite your provision will go down. This will be coming under your long-term provision. So long-term provision में 1,000 goes down. And now the thing is, liability went down in books. ये books में liability went down. Books में liability, or you recorded a gain here. That gain will be taxed in future. So DTL will come up. Okay, the DTL rupees 300. यहाँ पे DTL rupees 300, but this effect will come in OCI. अच्छा, if main item goes in PNL, the DTA DTL impact goes in PNL. If main item goes in OCI, the DTA DTL impact goes in OCI. अच्छा, net DTL in your balance sheet will be, net DTL in your balance sheet 6,000 plus 6,000, 12 minus 4,800 DTA plus 300 DTL, 5,100 is net DTL in balance sheet. Okay, check. The financials are not yet approved. You're required to ascertain whether financial statements are correctly presented. No. If not, prepare the revised financial statement. Let's prepare the revised. So check out over here. It is necessary to revise the financial statement of Soft Bharti as per Ind AS. Your parent follows Ind AS, you need to follow Ind AS. New P&L. New P&L, okay. Revenue from operation same. Revenue from operation is same. Acha. Current investments 20,000 went up. Uska profit comes here. So this is 20,000 current investment ka. Here an opposite investment may added. Opposite investment may added. So in your asset, if you just check here, 20,000 added in investment. So under your current asset, there's a financial asset. Wahan pe investment. They are fair valued. Okay, done. Now, purchase of stock in trade, no change. Increase, decrease in stock, no change. Employee benefit expense. Employee benefit expense, no change. Acha, sir, wo 1,000 rupee actuarial gain, it comes in OCI. It comes in OCI. This is no change. Depreciation, no change. Other expense, no change. These are no change at all. This is the total expense. And now your PBT is coming this. And PBT is this. Your correct provision for tax is not 106,500, it's 125,700. So this becomes 125,700. I just highlight the things which are actually changing rather than ticking everything. So यहाँ पे ये change हुआ. यहाँ पे current tax has changed. Current tax has changed. 125,700. Opposite in your provision for tax, the short-term provisions, check out your short-term provision. Yera. So check out your current tax liability 125,700. It would have been given earlier 106,500. Make it 125,700 ho gaya ye. Okay. After that DTL. Okay, DTL total 5100 came, but 300 effect comes in OCI. So यहाँ पे 4800, 300 effect OCI में, ये OCI में ये रहा 300 effect. तो 4800 and 300 total becomes 5100 DTL in your balance sheet. So in your balance sheet, DTL becomes 5100. Did you got it? Okay, so profit done, and remeasurement wala 1,000 rupee, us pe 300 ka effect. Net in OCI is 700. Total comprehensive income 245,200. Total comprehensive income 245,200. Now going to the balance sheet, PP is same. PP is same. Achha, you have given a long-term loans and advances. I have given a loan. It will come back. It's contractual right to receive cash. The heading financial asset came. Heading financial asset came. So under financial asset, we have this other financial asset 40,000. Achha, and capital advances are a part of other non-current asset 50, no change. Okay, under your current asset inventory. Now this heading financial asset came. Under financial asset investment, we already did trade receivable. Cash and cash equivalent, other financial asset. Okay. Now, under your equity and liability, you have equity. Under equity, the word is equity share capital. Word is equity share capital, and then other equity. Okay, then other equity. Now, just check out. You have this 245,200 is the correct profit. Total comprehensive income. The 245,200 will be coming. 245,200 will be coming. Acha, now your actuary reduced your provision by 1,000. So that short term, that long term provision may say 1,000 rupee gone. That long term provision may say 1,000 rupee gone. Okay? Your trade payable will be a part of financial liability. Trade payable will be part of financial liability. This is other current liability payable to government. And under your financial liability, other financial liability of 15. Remember that 45 other current liability given. 15 related to dividend cancelled, 15 related to dividend cancel, 15 related to government will appear under other current liability, and remaining 15, assuming it's a contractual obligation to pay cash. Assuming there's a contractual obligation to pay cash, it will come under other financial liability. Ye 15 is other financial liability. So that comes over here, other financial liability. Any doubts? Anybody? This is understandable, just a mixture of your schedule 3 and all the Ind AS together. Tulsiram, Vishnupriya, Vidhi, Pooja, any doubts? Bhavesh, any doubts? Thank you. Okay, so let's move ahead. Going to the next question, question 6. And please make sure this big questions, at least you go home and revise it once. Okay, now Master Creators Private Limited, a subsidiary of a listed entity. So you're required to follow Ind AS. Your parent follows Ind AS, you are also required to follow Ind AS. Following draft balance sheet is given. Draft balance sheet. So changes can come. Okay, asset side, good. They have started with asset side. Under non-current asset, PP. Okay, under financial asset, they've written other financial asset, security deposit. Okay, then so financial asset over ho gaya yahan pe. Financial asset is over. Okay, then they've given other non-current asset, capital advances. Capital advances come under other non-current asset, correct. Deferred tax asset, correct. Okay, under your current asset, trade receivable should be actually coming below. Trade receivable should be a part of financial asset. Trade receivable should be part of financial asset. Then inventory. Okay, investments, other financial asset, cash and cash equivalent. So trade receivable should be part of financial asset. Should be part of financial asset. So till now only one mistake. Okay, after that, under equity and liability, we have equity share capital, other equity. Other equity should be part of equity. Equity ke andar equity share capital, other equity. Then comes liability. Under liability, there's a non-current liability. Under non-current liability, deferred tax liability, borrowing should be part of financial liability. There should be a heading financial liability under non-current liability. Okay, under current liability, they've written, under current liability, they've given other financial liability, trade payable, current tax liability, that's okay. Okay, that's okay. Now, 1st April 1. 1st April 1. The balance sheet given is March 2. 1st April 1. What happened 1st April 1? 8% convertible loan. 8% convertible loan with face value 64 lakh was issued. Redeemable in 2005 at par. Redeemable 2005 at par. Alternatively, it can be converted into 100 shares for each rupees 200 worth of loan. Okay, can anyone tell me how many total shares to be issued? 100 shares for each 200 rupee worth of loan. The 200 rupee loan, 100 share. To 64 lakh rupee loan, can I say 32 lakh shares to be given? 32 lakh shares to be given. So either the holder can go for cash or the holder can go for shares. Can I say it's a compound financial instrument? It is a compound financial instrument. It should be split between liability component, equity component. Did you find anything in your balance sheet? Liability component of compound financial instrument or equity component of compound financial instrument? No. They would have just shown 64 lakh as liability. They have shown 64 lakh as liability. Mila ye wala? It should be split. It should be split. Liability component, equity component. Okay. Now, how do I find liability component? How do I find liability component? If they go for cash, what I have to pay? I have to pay 64 lakh ka 8%. I have to pay 64 lakh ka 8%. It's 512. Year. This is 2001, 2005, right? 1, 2, 3, 4. Okay, what I need to pay? 5,12,000, 5,12,000, 5,12,000, 5,12,000, and fourth year I also have to pay 64 lakh. Okay, discount it by a rate which doesn't have conversion option. Discount it by a rate which doesn't have conversion option, 10%. Loan without conversion option ka rate 10%. So at 10% I have to discount it, and then I find present value. This is the liability component. This is liability component. Remaining will be the equity component. I hope this is clear. Okay, it has to be split, liability component, equity component. Now, if you check out the solution, they would have given you. Here, note 11. Note number 11. So, amount to be recognized as liability 5974. We received 64 lakh. So, equity becomes 424,960. Equity becomes 424,960. Is it clear? Okay, now interest expense. Okay, we are paying 512. Interest expense will be 5975,040 into 10%. The interest expense will be 597,504. So interest accrued is this. We paid is 512. Closing balance of liability 60,60,544. Closing balance of liability 60,60,544. Now check in your P&L. Finance cost to be recognized is this. But already charged in P&L is 512. The difference to be charged is 85,504. And liability component is 60,60,544. So it was 5,975, us pe 10% interest accrued. We paid 5,12,000. This is the closing balance. I hope this is clear. So we need to split the compound financial instrument into liability component, equity component. This was one point. So this is a Ind AS 109. Now let's move ahead to other points. First point done. They've written interest of 5,12,000 paid and included as finance cost. Okay. Now after the year end, they have given directors have recommended a dividend 50,000. The same has not yet been accounted in financial, correct? They have recommended dividend not been yet accounted. This is correct. No adjustment required. Okay, other financial liability, other current financial liability, wages payable, contractual obligation to pay cash. Salary payable, contractual obligation to pay cash. TDS, statutory obligation. TDS is a statutory obligation. It's a statutory obligation. It will come under other current liability. It's a statutory obligation. So here there is a change. I have to remove from other financial liability 81,000 to be removed. It will appear where? It will appear under other current liability. Okay, so let's do one thing. Other financial liability. Okay, Mila 2,564,000. Okay, out of 2,564,000, remove how much? Out of 2,564, remove how much? 81265 minus 81265 to be removed 119,299. So go and check the solution. Okay, did you find 119,299? And this comes under other current liability. This comes under other current liability. Done, this point over. It's a statutory obligation, other current liability. Okay, interest accrued, it's a contractual obligation to pay cash, fine. Okay, PPE consists of following. PPE में building held for admin purpose, PP. Land capital appreciation, this is investment property. This is investment property, not PPE. Remove from PPE, show under investment property. Vehicles, fine. Factory premise construction started on 31st March, no depreciation, construction activity will take, so this will come under CWIP. This will come under CWIP. So remove this two. So this two, one goes in investment property, one goes in CWIP. The total under PPE will be 3750,250 plus 1237,500, 4987 will remain. Okay, so coming to solution C, 4987. One thing goes in CWIP, one thing goes in investment property. One thing goes in CWIP, one thing goes in investment property. Okay, this point also done. Okay, other financial asset. Other financial asset. Interest accrued, it's other financial asset, correct? Prepaid expense. I have a right to receive goods or services. Right to receive goods or services. It will not come under other financial asset. It will come under other current asset. It will come under other current asset. So I need to remove 90,000 from other financial asset. I need to remove 90,000 from other financial asset. It should come under other current asset. Check the question. Other financial asset will have 217,370. Out of 217,370, remove 90. Out of 217, ये रहा, उसमें से 90 removed, 90 comes under other current asset. 90 removed, 90 comes under other current asset. Done. Okay, current investments. I have some current investments which are held for trading. If they are held for trading, they are carried at FVT PNL. They are carried at FVT. They should be carried at FVT PNL. Okay, purchased at 55,000. And they are at cost in your book. The fair value is 60. Okay, to make it 60. Make it 65,000, that goes up. Opposite side profit goes up. Other equity. So 5,000, this will go up. Ye raha, check karo, ye 5,000 went up. Opposite other equity. So I go down to other equity. Other equity mein 5,000 added. Other equity mein 5,000 added. Acha, this was the additional interest. Books mein interest was 512, but actually it should not be 512, it's 5975 something. The additional interest. ठीक है? And this is the equity component of compound financial instrument we already found. Now, next point, trade payables, creditors, trade payable and trade receivable are due within 12 months, fine. There is no change in equity share capital, fine. Company has intention to set off DTA, DTL. So DTA, DTL given, net should appear in balance sheet. Other equity consists of retained earning, opening retained earning given. Opening retained earning given. Acha, then PNL was given this time? No, no PNL not given. Opening retained earning is given and then closing is also given. Kitna tha closing, check karo. Other equity 25,00150. 25,00150. And opening is this 2,500,150, and this is 2,125,975. So current year profit was 374,175. Okay, the current year profit was 374,175. Now usme there are some adjustment. So this is opening. This is opening. Current year profit 374,175 plus 5,000 investment going up minus 85504 additional interest. So current year correct profit. This is current year's correct profit 293,671. तो ये how did they found? ये opening closing का difference. This is the current year profit. Opening closing का difference is current year profit. Then 5,000 related to investment going up not taken. 85504 additional interest not taken. Correct profit is this. Okay, this is done. This is your other equity over. This is your other equity over. No change in capital. Capital is same. Okay, I can tick capital. I can tick other equity. I can tick capital, I can tick other equity. Okay, in your loan now it's 6060,544. That's already done. Now coming back to the question, no dividend is paid. Assume the deferred tax impact on above adjustment is correctly calculated. Means okay, investment going up in your book. Investment going up in your book, 5,000 investment went up. Tax it will be taxed later. Should I do DTA, DTL adjustment? Should I do DTA, DTL adjustment? So last question we did. This question, don't do it. Question clearly says assume the deferred tax impacts are correctly calculated. So don't do it. Don't do it. So DTA, DTL net will come in your balance sheet. DTL was 474,850 and DTA is 254,150. The difference 22700 DTL. DTL is 22700. Did you found DTL is 22700? Okay, and I just go to question and write तो यहाँ पे therefore no adjustment of DTA DTL. No adjustment in DTA DTL required. Okay, you're required to redraft the balance sheet to prepare a correct balance sheet with details. Okay, prepare a correct balance sheet with detail. We discussed all the points. Remaining figures coming same from balance sheet. Remaining figures are coming same from balance sheet. Any doubts? Anybody with this question? All figures which were changed, I have ticked it. Other all are coming same. Please make sure this question and the last question you're going home and revising without fail. And see, these are the notes or explanation, whatever I said, PP. So under your PP, they have given basically only two items will be coming. One, investment property removed, CWIP removed. Okay, so only two items are coming. PP not ready for intended use, disclosed as CWIP. So these are definitions. They've just given a definitions. Okay. This all is fine. Other current asset. Okay, not relevant. Fine, leave it. Your DTA DTL net is to be shown. You already done it. Okay, coming to question number 7. Okay, coming to question number 7. Mumbai Challengers Limited. Okay, Mumbai Indians ki jagah they're telling Mumbai Challengers Limited, a listed entity, a sports organization, owning several cricket and hockey teams. Okay, it's a listed entity, they'll follow in days. And following issue is given: owing to proposed schedule of Indian Hockey League as well as Cricket Premier Tournament, Mumbai Challengers Limited needs a new stadium. Okay, Mumbai Challengers Limited needs a new stadium to host the event. So they buy a stadium or they construct a stadium. If they buy a stadium or construct a stadium, can I say it will come under PP? The stadium will form part of PP. Understandable? Now, the construction began. They began construction of stadium on 1st December and completed in 2002-3. Completed in 2002-3. ठीक है, तो December this year I started, next year it has got completed. Currently this is 2001-2. We started in 2001-2, it will be completed in 2002-3. ठीक है, the cost of construction is 140 crore in December. Okay, thereafter 350 crore every month till the end. Okay, so December में I spend 140 crore on stadium, then 350 crore every month. Acha, you don't have any specific borrowing. You don't have any specific borrowing, but you have some general borrowings. You have some general borrowings. But regular overdraft or general borrowings are there. ठीक है. Weighted average cost of borrowing is 15% per annum. Okay, for the period December, this is 15% on annualized basis. Okay, they're asking treatment of borrowing cost. See, I don't have a specific borrowing. Achha, if I have a specific borrowing, the total interest of specific borrowing, if I have a specific borrowing, the total interest of specific borrowing capitalized less income from temporary investment. Less income from temporary investment. But if I don't have a specific borrowing, I have a general borrowing, I can capitalize to the extent spent and assume the spending is out of general borrowing. So don't try to correlate really money spent or not, but assume the spending is out of the general borrowing only. Okay, so now tell me, December mein how much did I spend, and I assume it's at beginning of every month. Okay, so first December, how much did I spend? Sir, 140 crore. 140 crore, uska 15%, it is used for how many months? 4 months, December, January, February, March. Okay, first January I spend how much? 350 crore every month. Into 15%, I can capitalize interest for 3 months. Okay, first February again 350 crores. And first March again I spend 350 crores. So this much interest can be capitalized. This is 2 by 12, this is 1 by 12. So how to deal with the borrowing cost? This much cost, a borrowing cost can be capitalized. 140 into 15% into 4 by 12. This is coming 7. 350 into 15% into 3 by 12. 13.125. 8.75, 4.375. This can be capitalized subject to this should not exceed the actual borrowing cost incurred. It cannot exceed the actual borrowing cost incurred. So check the solution. ये आ गया, borrowing cost to be capitalized is 33.25. Same thing. But it should not exceed the actual borrowing cost. Any doubts? Anybody? Okay, going to second question over here. Mumbai Challengers Limited acquire and sell player registration. Registration is right. तो player का right on regular basis. If you have a registration, the player will play only for you. This player registration a contractual obligation between player and company. ठीक है? And the cost of acquiring player registration includes transfer fee, league levy fee, player agent fee, etc. ठीक है? The club basically at the end of each season we try to see the contract with the players and we decide which player we want to retain, which player we want to sell. Which player we want to retain, which player we want to sell. Player registrations are also sold during the season, often etc. etc. It becomes clear that player will not play for club again if at all it's permanently removed due to injury. Okay, now the player registration of certain players were sold after year end for a total proceeds of 175 crore and this registration had been Achha, the question over here is, what is your advice on accounting for acquisition of player registration, extension, review and sale of player registration? Now tell me, if I buy the rights of player, the player will play for me for 5 years. Player will play for me for 5 years, he cannot play for anybody else. So can I say player registration are kind of intangible asset? And they will be amortized over 5 years. Achha, if you sell an intangible asset, the difference profit loss will go in P&L. Okay, they are kind of intangible asset. You should recognize intangible asset basically. The cost associated with player registration will be capitalized as intangible asset. And it would include, the cost would include the transfer fee, league levy fee, agent fee, whatever, etc. Amount capitalized should be amortized over the period of contract. This is acquisition. Now when I'm selling it off, tell me, if at all there's an intangible asset, it's held for sale. If it's held for sale, it will be accounted as per 105 now. Until it is actually sold also. Till it's actually sold, if it's classified as held for sale, 105. So player registration will be classified as held for sale under 105 when their carrying amount is to be recovered principally through sale. And for this it should be available for immediate sale and the sale is highly probable. 2 criteria. It's available for immediate sale, sale is highly probable. So you need to apply Ind AS 105 that time. You need to apply Ind AS 105 that time. If it's classified as held for sale. Once the condition for classifying as held for sale have been fulfilled, once the criteria for held for sale is fulfilled, you will now be showing it at lower of carrying amount and fair value less cost to sell. Amortization will stop. That is in accordance with 105. Profit or loss on sale of players will be computed by deducting the carrying amount with the what you recovered, and difference will be recognized in P&L. Difference recognized in P&L. Player registration sold after year end is a non-adjusting event. Player registration sold after year end is non-adjusting event because you sold after year end, it is removed from your book next year only. It's a non-adjusting event. Okay, next is impairment review. They've written all things. Acquisition, uske baad they'd asked sale, uske baad they'd asked extension review, the impairment review. We bought a player, but now the thing is we will not be able to recover the money. That's value going down. तो उसके लिए Ind AS 36. Okay, we are required to test the asset for impairment. Asset is said to be impaired if recoverable amount is less than the carrying amount. Okay, in the given scenario, it is not easy to determine value in use of any player in isolation, because player doesn't generate cash flow on its own, the team generates cash flow. ठीक है, तो better is basically you'll be having a CGU concept. So while any player cannot really be separated from the single CGU, that is a team, ठीक है, तो generally CGU wise impairment testing is to be done. Normally player का नहीं हो सकता, but there may be instance where a player is taken out of the CGU when it becomes clear that he or she will not be able to play for club again. If such a circumstances arises, then the carrying amount of player should be assessed against the best estimate of player's fair value less cost to sell. Acha, now tell me, if you are continuing playing, I cannot find your value in use. Value in use is for the team. But if you can't play only, imagine permanent injury is there, now you can't play. So value in use is 0. You can't play, value in use is 0. So now I need to compare the carrying amount with the fair value less cost to sell, and an impairment charge should be recognized in P&L. Did you understand? So if you continue playing, I cannot find your value in use alone, so I have to basically do impairment testing of a CGU team itself. But suppose you have a permanent injury, some instance player is taken out because he cannot play for the club again. Example is permanent injury. So now there is no value in use of yours. So now there is no value in use, then I'll compare your carrying amount with the fair value less cost to sell. Your carrying amount with the fair value less cost to sell. Okay, done. Next question is C point in this. This C point. Okay, there were certain players sold after the year end also. Yeah, I highlight this line. Okay, Mumbai Challengers measures its stadium based on revaluation model. It's a PP. Revaluation model followed. Remember, PP subsequently can be cost model or revaluation model. Airline company has approached the directors offering 700 crore for property naming right. Okay, you're not selling stadium, but stadium ka naming right. You know, Ahmedabad ka stadium is called Narendra Modi Cricket Stadium. Same way, Mumbai wala is Wankhede Stadium. The naming right. So this airline company is telling that, okay, you name it based on us, we give 5 years ke liye 700 crore rupees. 3 directors are on management of Mumbai Challengers and the airline. Additional regulator require financing of both hockey team. This regulation prevent contribution to capital market from related party, etc., etc. Now see, there are directors which are common. There are certain directors which are common, and statutory legislation regulate the financing of hockey and cricket clubs. The regulation prevent contribution to the capital from related party. ठीक है? And Mumbai Challengers want to know how to account for the naming right in the valuation of stadium. The question is how to account for this naming right. How to account for this naming right. Okay, so first of all, they are having your stadium as per revaluation model. For the naming right of the stadium also, people are giving you money. So can I say the fair value of stadium would have gone up? fair value measurement is as per Ind AS 113. Okay, the Ind AS 113 is the fair value measurement. Ind AS 113 is the fair value measurement. Okay. Now, the status of property naming right presents complication when valuing the property. Whenever you're valuing property, वो naming right के पैसा मिलेगा, ये मिलेगा, वो मिलेगा. We are trying to have a greater fair value. ठीक है. The status of the property indicates its suitability for inviting sponsorship attached to the name. Fine. So you could include property naming right in the valuation of stadium. तो stadium के valuation में can I include property naming right का पैसा which I'll be getting? Yes. And you amortize over the remaining life of stadium. Okay, check the life of stadium. Is it given anywhere? Naming right is for 5 years. Stadium की life is given. No, how did they say you amortize over 3 years? They've written amortize it over 3 years. Okay, amortize it actually over 3 years की जगह life of stadium. Okay, now there's also a related party wala thing. Directors are common. I just highlight that line in the question. Directors common. Okay, we have written 3 directors are on management board of both Mumbai Challengers and the airline. So related party transaction. Okay, now just tell me one thing. Both the places KMP. We did Ind AS 24. Remember, if you Ind AS 24 May, I told you one place you need control, joint control, other place control, joint control, significant influence or KMP. Acha, both place KMP. Just we have a directors common. Are we related party? Both place KMP. Same director, both the place. A limited, B limited, both have a same director. So does A and B, is A and B said to be related party? No, here just board of directors are common. So check out over here Ind AS 24 related party. Okay, so now they have directors or KMP in common. They have directors or KMP in common. So check over here. Ind AS 24 deems that the parties are not related just because directors are common. One place control, joint control, other place control, joint control, significant influence or KMP. Both the place KMP will not work. So यहाँ पे this will not be a related party वाला thing. However, the regulator will check. So it's not a related in absence of an information to the contrary. In absence to any information to contrary, it appears they are not related. However, regulator will check. If regulator says it's a related party thing, disclosure is required. So if the deal is deemed to be, related party, then you are required to check whether the fair value hai, nahi hai, disclosures, etc. will be coming up. Okay, last question of this chapter, question number 8. Last question of this chapter, question number 8. Neelachal Gas Refinery Limited, listed entity. You are in production and trading of natural gas and oil. Okay, you own a underground storage facility jointly. You jointly own an underground storage facility with another company, Simanchal Refinery Limited. Both the companies are engaged in extraction. Okay. Neelachal owns 60% underground facility, Simanchal owns 40%. They bear the cost also that way. The storage underground facility is pressurized so that the gas is pushed out whenever extracted. When the gas pressure is reduced, the remaining gas is irrecoverable. Okay. Now the question is about your agreement with Simanchal. About your agreement with Simanchal and some irrecoverable gas. ठीक है. Both the companies have agreed to share service and cost accordingly. And they require a unanimous agreement. Decisions require a unanimous agreement. My question, Nilanchal owns 60%. Can they take decisions on their own? Nilanchal owns 60%. Can they take decisions on their own? No. Sir, decisions require a unanimous agreement. So it's a joint arrangement. It's a joint arrangement. Okay, new entity not created, it's a JO. New entity not created, it's a JO, joint operation. ठीक है. Now, the underground facility is pressurized so that the gas is pushed out. When the gas pressure is reduced to a certain level, the remaining gas is irrecoverable. And you cannot get it back until it is decommissioned, until the whole facility is removed. ठीक है. And now we are required to give the treatment. So first of all, check out, it's a joint arrangement, not the joint arrangement which is not structured through a separate vehicle. It's called as a JO. Under JO, you record your share of asset, your share of liability, your share of revenue, your share of expense. The joint operator will account for its share of assets, liabilities, revenue, expense relating to involvement in JO. Okay, so based on above, the agreement with Simanchal Finance, the Simanchal Refinery Limited is a JO because new separate vehicle is not formed. New separate vehicle is not formed. The decisions require unanimous agreement. Now you will record underground facility, it's a PP. So you will record your share of PP. So Nilanchal will record their share of PP. Nilanchal will record their share of PP. Plus, whenever I am recording a PP, there will be some dismantling required at the end. The present value of that estimated dismantling cost, I create a provision, I add it in the asset. So PP debit to provision for dismantling. So initial cost of dismantling is also included in the cost of PP. This is done. This is done. Okay, now irrecoverable gas. There's some irrecoverable gas. It will be capitalized. You cannot extract it. It's first time when you put it, it's irrecoverable. So that's needed to operate the facility. ठीक है. You classify your share of irrecoverable gas as PP only. You classify your share of irrecoverable gas as PP only because it's necessary for the storage facility to perform. If you can't have that much gas inside, it can't work only. And it will be coming out at the end. It will be as PP only. This being a part of storage facility should be capitalized as a component of the storage facility, depreciated over its useful life to its residual value. I don't have to make it zero, I have to make it to its residual value. Upon decommissioning, it is recovered and sold, but pura paisa nahi milega, it's kind of some gas goes away kind of thing. Difference gain loss goes in P&L. The sale of disposal, irrecoverable gas is accounted as disposal of PPE and the resulting gain loss goes in P&L. Any doubts, anybody? So over here, even though you hold 60%, you can't take the decisions alone. Decisions are to be taken unanimously. It is a joint arrangement. Okay, new entity not created. It's a joint operation, not a joint venture. Now, relating to that gas which will remain there only, cannot be taken out. So day one, storage facility, it's PP. Our share of PP I'll record. ठीक है. Now dismantling expense का cost, उसका present value, our share I'll be recording, an entry will be PPE to provision for dismantling. Acha, that irrecoverable gas, it's a part of PPE only, because without that the storage facility cannot work. So it's a part of PPE only. It will be amortized over the useful life, depreciated over useful life to its residual value. And last way, when it's dismantled and taken out and sold, it's treated as a sale of PPE. Did you understood? Okay, now coming to B point. You have a 10-year contract with Uttaranchal Refinery also for purchase of natural gas. For purchase of natural gas, and you paid advance. You paid advance. Advance carries an interest of 12.5% per annum. Okay, I've given an advance to them. Advance gives me 12.5% interest. Okay, they will supply me fixed quantity of gas every month. Okay. Additionally, there is a price adjustment mechanism whereby the difference between the forecasted price, prevailing market price is settled on quarterly basis. ठीक है. So we have paid some advance based on forecasted price. We have paid some advance based on forecasted price. Now last May, quarterly basis, actual price, forecasted price, the difference we pay in cash. And if at all they do not deliver the gas, you have a right to compensation. Okay, now how to account for this contract? How to account for this contract? Okay, now question. Can I say there's a contract to get delivery of the gas? It's a contract to buy or sell non-financial item. It's a contract to buy or sell non-financial item which will be settled by delivery. If it is to be settled by delivery, it's out of scope of 109. But if it is not by delivery, imagine I know they will not be delivering me. If they will not be delivering me, I can go for compensation, though cash milega. Then it's covered. So check out over here. The contract with Uttaranchal will result in a physical delivery of gas. Accordingly, it appears the contract will be out of scope of 109. And it's treated just as a normal executory contract. When they deliver me goods, I have to pay money that way. It's out of scope of 109. However, argument can be placed that the contract is net settled due to penalty mechanism. So if they are not going to give you cash, if they are not going to give you cash, if they are not going to give you delivery, settle hoga, they will pay me penalty, then yes, it comes over here. Further, if natural gas is readily convertible into cash at location, this contract could be considered net settled. ठीक है? So it will be covered, but that's okay. However, the contract will probably continue to be regarded as own use. It is for own use, and as it's for own use, it should not be covered under 109. Did you understood? अच्छा, prices which you paid advance में थोड़ा थोड़ा advance दे के रखते हो, they have to give you goods. Against advance also they will be giving you goods. It's out. It's not a financial asset. Against advance also we receive natural gas. So we do not have contractual right to receive cash. Therefore, it is not financial asset. Okay, the advance is not your financial asset. You'll be getting goods. And number two, Over here, there's a contract to buy or sell non-financial item to be settled by delivery. It's outside the scope of 109. Any doubts? Anybody? We did whole chapter analysis of financial statement fully. The whole of your chapter revised in 2 hours. Analysis of financial statement. Now, I came across a very simple chart. This is called as why worry chart. Yeah, this is called as a why worry chart. It starts with like, do you have a problem? Do you have a problem? If answer is no, so why worry? There's no point of worrying. I don't have a problem only. Do you have a problem? If answer is no, so why worry? But most of us, we have some or the other problem. Financial problem, health के problems, girlfriend boyfriend problem, office के problem, sir पढ़ाई के problem. If answer is yes, so what to do? Now yes, so what to do? तो क्या करेंगे? Can you do something about it? अगर है हाँ प्रॉब्लम है तो can you do something about it? Okay, there's a problem. Can you do something about it? If yes, तो क्या करो? Then do it. And do it. And if you do it, can I say there's no point of worrying? There's no point of worrying. Do it. So do you have a problem? No, to why worry? If you have a problem, can you do something about it? Yes, to do it. And if at all you can't do anything about it, I know there's a problem, I can't solve it. There's no point breaking your head into something which you can't do anything about. If there's no point breaking my head into something I can't do anything about, leave it na. जो होगा वो देखा जाएगा. The God will do good for me only. If I know I can't do anything about it, please stop thinking about it and concentrate on things which you are doing. This is nothing but a why worry chart, a very simple thing. If you have a problem and you feel you can do something about it, do it. But I know I can't do anything. मेरे हाथ में ही नहीं है. मेरे हाथ में ही नहीं है. Now just imagine a simple thing. The repairing work in my house is going on, and this is actual fact. The repairing work in my house is going on. Suddenly a rain comes. 3 days, the whole basically city was kind of gutted in water around 2 feet. And now my work for 2-3 days stopped. I cannot do the work. I wanted to shift on timely basis, but now I can't do it. Is there anything I can do about it? No. There's no point worrying about the things which are not in your hand. But things are in your hand. You can do something about it. Do it. Chalo, that's all for the day. Thank you so much. Bye-bye. Take care, everyone.